Hey, good morning, everyone. It's Matt Donahue with Mission Financial Planners, and this is your weekly market update for the week ending. Friday was the 25th already, July 25th. We're going to talk about home sales, some economic indicators, identity theft, and why planning for healthcare and retirement is really no longer optional. It's got to be an essential part of your retirement planning. So let's get into the week in review. We saw some mixed signals in the economic data this week. New home sale rose to 627,000 units. That's a bump in housing activity despite some affordability concerns. Durable goods orders dropped sharply, though, down 9.3% month over month, largely due to fewer aircraft orders. The U.S. composite PMI jumped to 54.6, down from 52.9, which does signal an expansion in both services and manufacturing. So in short, while the consumer is still spending, businesses are starting to pull back a little bit on big ticket investments. Next up, buckle in for the first estimates of second quarter GDP and the latest non-farm payrolls report. Those are going to come out this week. We'll be watching closely for signs of resilience or cooling in the job market and any implications for interest rates. Speaking of housing affordability, let's talk about that a little bit. Mortgage rates are getting a lot of blame, but what's the real culprit here? It's really home prices. Today's 30-year fixed rate, which is around 6.74%, is actually historically normal, and it's lower than it's been about 60% of the time going back to 1971. But home prices, which have been turbocharged the last 2 decades by ultra low rates and sluggish building, are now so high that a 20% down payment consumes 100% of the average household's annual income. So even if rates drop, prices could rise, canceling out the benefit. Lower monthly benefits might come, but down payments, that's still going to be a mountain that has to be climbed. Time for a little Stoic wisdom. This is from Musonius Rufus. Some people are sharp, others are dull. Some are raised in better environments, others in worse. You know that frustration you feel when someone just doesn't get it? Well, check your privilege. Not everyone had your head start. Philosophy, like planning, it's personal development, and not everyone is going to be on the same path or on the same timeline. So my advice there, and certainly I'm lucky to have been surrounded by people who have treated me this way over the years. More patience, more empathy, and guess what? That will relate in a better outcome. Tax tip of the week: protect yourselves from from identity theft. So what happens from a tax standpoint if you've had some identity theft issues that are messing up your taxes? Well, we're seeing more of that, and here's some things you can do. Number one is always file your return early. Beat the fraudsters to your refund. Don't give them a chance, in other words. Second thing, never respond to IRS requests by email. The IRS does not operate that way. At the most, you'll get a confirmation saying that your return was electronically filed and they received it. That is the most you'll get from them. The IRS form 14039, that is the form you use to identify identity fraud or identity theft. You also need to make sure you attach your government issued ID, driver's license, or passport are ideal. And if you have been compromised, maybe even more importantly, before you've been compromised, consider a credit freeze or fraud alert. Fraud alerts are free and they notify all 3 credit bureaus. So last point, identifying theft, it's not just a hassle. It can delay your refund. It can mess up your Social Security. It can even lead to financial losses that might qualify for casualty loss deductions on your tax return. So stay vigilant. A little bit about extended care planning. Healthcare is the iceberg that's coming up on your retirement plan. And then we all know about icebergs. You can see the tip, but you can't see the rest of it. So even if you're in excellent health today, planning for medical expenses in retirement is really a non-negotiable. The decisions you make about your healthcare in your 40s and 50s are going to define what your healthcare is like in your 60s and beyond. So you need to start thinking about this stuff right away if you haven't already. And as an example, a 65-year-old married couple could need over $300,000 for healthcare alone. And that doesn't include any kind of extended or long-term care expenses. What you really want to be doing is making good decisions in your 40s and 50s, but then by the time you're 63, that's when you need to really get down to nuts and bolts. Medicare plans and enrollment dates are going to be important. Supplemental policies are going to be important. You're going to need out-of-pocket cost estimates. And remember, the healthier you are, the more you control and the more you retain. A little treadmill time today, a little walking time today could save you from dipping into travel or leisure funds later on. That's your market tax and planning update from Mission Financial Planners. If this raised some questions or sparked an aha moment, reach out. Keep in mind, we are going to break down the BBB tax bill, the new tax bill, this Wednesday, July 30th. We're going to do it at noon Central Time, which is 10 a.m. Pacific Time. We're also going to do it at 8 p.m. Central Time, which is 6 p.m. Pacific Time. We're trying to accommodate our West Coast clients as well with that because we feel it's really important. Hey, if you want charts, resources, disclosures, any of that stuff, click the links in the descriptions. But until next time, stay informed, stay prepared, and rock on. Thanks, everyone.